So, welcome to ACY Securities. I'm Ira Reyes, Macroeconomic Strategies. As the S&P 500 hovers near record highs, a high-stakes collision between surging oil prices and today's critical CPI report threatens to derail the entire equity rally. Just a reminder, this represents my personal view of market movements and does not constitute investment advice. Trading involves a high degree of risk. Please ensure you have a solid risk management strategy in place. My strategic analysis is I utilize a dual-layered approach that synthesizes macro-level catalysts with technical precision, and by cross-referencing fundamental shifts against statistical trends, I execute high-conviction trades where market sentiment meets optimized expectancy. Before we start, please don't forget to like, share, subscribe to our channel, and for further information about in-depth analysis, you can join our discussion on Discord. The link is on the description box below. In terms of fading hopes or in terms of so the US was warned of rising fuel prices as a persistent maritime attacks and also a standoff with Iran over stringent preconditions. The team hopes for reopening the Strait of Hormuz. Now, with this having in a shortened period right now that we are trying to look at a resolution between the two, the global has already been looking on the inventory in terms of oil and at the same time the commodities. So in terms of looking at the worst case scenario, because again, we are tracking on the inflation, the interest rate, and another interest rate, if so on. So if there is a sustained closure of the Strait of Hormuz and also escalating maritime attacks that involves a severe global stagflationary crisis, so it is characterized by several compounding systematic shocks. Again, by having this report, we can foresee actually forecasts that we are going to retrieve or those days wherein there is extreme energy spikes, like the Brent crude could surge towards another $200 per barrel as over a fifth global petroleum and also the LNG supplies are choked off without viable pipeline alternatives. Another is in terms of global economic contraction. So the sudden loss of energy, it would trigger a deep global recession and also forcing widespread industrial shutdowns in import-dependent economies. Another is in terms of a runaway inflation or also the central bank paralysis. So this soaring energy would, at the same time, those food costs, it could spark uncontrollable inflation. That is the worst scenario that we can take a look at, having this precaution. Now, it could also permanently inflate global trade costs and also depress long-term economic growth. So again, there would be a secondary supply chain freeze because of the persistent maritime attacks. Another is that it would also leave the central banks powerless just to to cut the interest rates without worsening the crisis. So those are the scenarios having this article provided, being forecasting what could happen across the market or financial markets, plus how it will affect the global growth. Again, we have already provided on the first half, the forecasts were downgraded, and it was also beat by the estimates because across regions globally, the downgrade forecast was surpassed. In short, the global was able to cope up during the first half of 2026. And imagine that time, the UAE was not yet in exodus in terms of OPEC. And these countries, or the OPEC plus countries, are trying to maintain those quotas. So that is our global concern. This is an emergency, to be exact. And we can see from time to time, if there is no between these true stocks, between these two countries, we can see again these energy spikes. And not only that, it could also pass on to the consumers like us individually, how much is this specific commodity. So that is what we have to look right now in terms of this global geopolitical risk that is really affecting not just one specific country, but also if those countries are also high energy importer. Now, in economics, this is known as a example of a supply side shock. So specifically, an adverse supply shock or negative supply shock, which drives the economy into stagflation. So an adverse supply shock happens when there is a sudden event that makes it much harder or more expensive to produce goods, which instantly it shifts the burden across the entire economy. So again, the trigger here is that instead of people simply wanting to buy more things, for example, which of course it causes normal inflation, a supply shock hits the production side, like shutting down the Strait of Hormuz, which really chokes off the oil and energy needed to run factories and also transport goods and protect at the same time the consumers. Now, here another is what could be the domino effect of this one. So because energy powers almost everything, so the cost of making, growing, and shipping everything from food to plastics, it would really expect to skyrocket. And in terms of economy, so of course, businesses must raise their prices to survive. And that would result right now into inflation. But consumers, they have to less money to spend because everything costs more. That means causing the economy to slow down or shrink. In short, it is a worst case double blow. Prices go up at the same time, economic growth goes down. So fixing this severe economic crisis, it would require a combination of diplomatic peace deals to reopen the shipping lanes and military protection as well for cargo vessels. And at the same time, emergency releases of government oil reserves as an example, and also a very careful government management to control this inflation and protect consumers. So here, reaching political deals and using military escorts to safely reopen the Strait of Hormuz is also the fastest way to fix the crisis. Another is the SPR, or the Strategic Petroleum Reserves. So again, these releases that the governments can flood the market with emergency oil stockpiles, and just to calm the panic and also temporarily lower the soaring energy prices. And in terms of accelerated alternative logistics, so rerouting oil through alternative pipelines and finding these non-Gulf energy sources that would help to reduce the reliance on the block choke point. Another is monetary and fiscal navigation. So governments, they must really carefully balance giving financial aid to those struggling citizens as well, while keeping interest rates high enough to control inflation. So again, this is the latest from the geopolitical tension. Now, for the economic news, we have the US 10-year Treasury yield. So let's take a look for at the same time on the stock. So investors awaited this critical inflation report that could influence the Fed upcoming policy decisions. Plus, Japan's manufacturing sentiment, it reached highest level since March, and at the same time, driven largely by strong semiconductor and chemical demand. And at the same time, for South Korea, the seasonally adjusted unemployment rate, it ticked up to 2.8% for the month of July. And despite this adding 108,000 jobs, with growth primarily concentrating in the services sector. Now, for the currencies, the dollar, it edged to 99.9 at the same time. So we can see that 99.9 is already tipping or tapping the 100 level for the DXY. And this would also cause having impact on the prices. So again, given that the United States, they impose tariffs, at the same time, importing products, for example, petroleum from the United States, expect it will be much, much higher costs. Now, for commodities, the gold, it rose to 4,400 an ounce, and supported by the anticipated U.S. inflation data, persistent central bank purchases led by China, and also a potential U.S.-Iran diplomatic arrangement regarding the Strait of Hormuz. So again, this is the catalyst right now for the gold, since there's ongoing tension inflation, interest rate. We can see already the performance of the gold surging within the week. Now, crude oil, it also reached towards the $84 per barrel, and also for its fifth consecutive session. And in light of these fluctuating diplomatic signals between Washington and Tehran, and despite there is a significant rise as well in U.S. crude inventories. So again, the U.S. Stockpiles, we watch it as well in terms of the negotiations happening in the Middle East and how it would impact again the global, at the same time, the markets, or particularly in the consumer goods. So again, let's take a look on the stocks right now. So US stocks, it finished lower yesterday with tech heavy weights sliding, and also while investors, they anxiously awaited the upcoming data, which is the CPI, following that there is a hint of a potential rate hike. So imagine if there is a hint of potential rate hike, we expect others have already priced in for that. Now, meanwhile, the European markets, it hit record highs and driven by strong gains in utilities. That is also tied to data center growth, and energy stocks supported the geopolitical tensions. And European equity markets as well, they are set for a muted open session today, as cautious investors right now, they weighed on these elevated oil prices, plus the upcoming German and Italy inflation data, and also a crucial US inflation report. And at the same time, the crude oil prices, it's really edging right now higher because of this ongoing uncertainty in the Hormuz. And at the same time, these major corporate moves highlighted high stakes investments in AI infrastructure. So again, to summarize, the catalyst within this week, because the big tech are those huge companies that already provided the corporate earnings. So catalyst would be still looking on the highlighted high stakes in investments on AI, or the capital expenditure, plus the inflation data report this week. Another is the headline that is really impacting the oil prices, which is the ongoing geopolitical tension. So those three factors are the key drivers within the week. Expect more high volatility. And again, second quarter earnings report, or during second quarter or half, is really expect there is a different volatility in the market because of the first half report plus the second quarter earnings. So again, it's all about projecting the next half of 2026. Now, Asian stocks, we saw today, it's mostly higher, and it also lifted by South Korean tech gains and also positive AI outlooks. And for the Taiwan stocks as well, it rose to 0.9%, and also it reached near 4-week high, driven by strong gains in electronic technology and major chip makers. And for the Australian stocks, it declined over 0.45% as well on 1-week low, following by the RBA's warning of potential monetary tightening. And the Nikkei 225, it advanced to 0.81%, supported by strong performances across multiple leading electrical and industrial stocks. Now, let's take a look on the report on the US oil. So again, oil prices, it climbed above $83 a barrel, as Iran insists the Strait of Hormuz will remain closed until the US unfreezes their overseas funds. And despite conflicting reports of a potential peace deal, so the market remains, of course, volatile as these diplomatic tensions between the two continue to escalate. Now, of course, the influence will be on the financial market, so there will be a stubborn elevated oil cost. It will really squeeze company earnings and heighten equity market swings. That's why we see the indices right now. It's really it's very uncertain right now when we look on the prices, and also while critically draining emergency crude reserves in terms of the economy. So ongoing disruptions here, if energy supply will drive inflation back up and also weaken economic expansion. At the same time, raising the risk of a market correction if persistent inflation as really it would push the interest rates higher. So here, these negative economic consequences, it will start showing up in retail inflation numbers and quarterly financial statements in roughly 1 to 2 months. So that having this report, expect in 1 to 2 months the retail numbers, indicators, we look on the consumer spending, and then at the same time, not only the consumer sentiment like the Michigan survey, but also we look on the manufacturing and the industrial. Now for the corporate updates, we have the Super Microcomputer and CoreWeave. So they both reported strong sales forecasts and also beating the estimates. And it was driven by the booming demand for AI hardware and cloud computing. And we also have the SpaceX is also launching new AI software that is designed to function collaboratively to handle daily assignments. So it's like a team that they're going to handle those tasks daily. So highlighting ongoing efforts right now to keep pace with their industry competitors like OpenAI and Anthropic. And today we have the inflation reports for release as markets right now will brace for key shifts following the July's figures. So again here, the Nasdaq as well. So at the same time, we have the Nvidia. So it is partnering right now with top Wall Street investment giants to source a massive $500 billion in debt financing for AI infrastructure and data centers, and also using high-powered computer hardware as collateral. And the coalition aims right now to provide Nvidia's largest customers with accessible capital to fund the next generation of AI. And here, provided that the Nasdaq is also acquiring the dark pool operator level markets, that means to expand its footprint in growing off-exchange equities trading sector. So the platform right now will be integrated into a new digital liquidity unit tasked with innovating trading hours and supporting tokenized securities. For the energy, we have in Qatar the LNG. It has already increased its liquefied or LNG gas loadings to their highest level in months in anticipation of potential reopening of the Strait of Hormuz, while exports remain heavily dependent on shipping conditions through the choke point. So right now, the talks between Iran and Oman as well regarding maritime access, it have reached an advanced stage. So that's the update right now. Now for the gold, the prices rose as investors right now, they monitor potential developments in the Hormuz and wait for the US data, which is the inflation. Now, markets are currently really cautious and assessing how rising oil prices and this upcoming report will influence the Fed's next interest rate decision. It's because are they going to retain the 3.75 or a potential really make it a reality check for the 4%, for example, to have an increase? So what another basis points that they could provide, or will they retain the 3.5 or 3.50 figures? Now, influence is that gold prices, we can see from time to time, it's already edging higher as the markets or the investors as well, they monitor these potential developments in the Hormuz. And at the same time, the US inflation. Now, this cautious trading, it also reflects a delicate balance. The markets weigh whether these rising oil prices will force the Fed to implement further interest rate hikes. And despite these short-term uncertainties, so the gold, it continues to show some underlying support driven by steady central bank purchases, like what happened last June, and also institutional demand. So the metal's near-term direction, it depends heavily on upcoming economic reports and how this energy market volatility impacts the monetary policy. Of course, when there is an impact on the monetary policy, you can see a swing on the gold prices. If the higher the dollar, the higher the interest rates, all supporting the currencies, it might also dampen the demand for the gold. And the thing is that how this institutional buying frequency is being done within that quarter. So again, that is what we track in terms of the gold purchasing. Now, let's take a look as well for the technology. So the memory chip giants like the SK Hynix and Samsung, they are planning to increase shareholder payouts through the buybacks and dividends as AI demand drives record cash flow. And this strategy, it aims to support share prices and provide as well as safety nets for investors that worry the current industry boom is reaching its peak. So by these cash returns with long-term supply contracts, so these companies also hope to reduce the market volatility and stabilize their value long-term. So again, you can see not only at this period, we expect more report relevant to AI infrastructure, capital expenditure for related to AI over the next half, because they are actually this has been forecasted 2023, around 2023-24. There was a collapse of Silicon Valley, if you can track what happened on that time. And after that, massive job layoffs across AI companies. And they have forecasted that the corporate earnings, the biggest supporter would be the AI. And that's why right now it's really happening. So imagine that 2 or 3 years ago, it was already forecasted that despite there was a fiscal issues across the United States, they were having difficulty to cope up in the interest rate. That was very high at that time. And there was also a second quarter report earnings in the 9-month report during September. So it was already forecasted years ago. Now it's already on its fruit, and we can see that this AI is going to be more hype. But in terms of tracking these stocks, as particularly how it would help as well, it's on a different. We have different approach in terms of companies to track how it would support not only the specific index, for example, the Nasdaq or S&P 500, but rather the demand. And right now, data centers, it's very costly right now because of the energy costs. So again, that's it for the updates for the corporate. At the same time for the gold, let's take a look on the S&P 500. So here we can see it's trading on this level at the 37.10. So again, it's really reaching an all-time high, and I provided here the immediate resistance. So again, this is 77.90. It is the resistance or the level to break the all-time to reach the all-time high region. At the same time, the previous resistance to break is now acting as a immediate support. So I have 76.15 and 75.79 is the previous resistance as well, now as a second support. And the lower region here is 73.66. That was a previous major weekly support. Now, I still have this 72.19.25 as the critical support region, meaning multiple losses and also lower momentum. That is if the index, there is no major catalyst, and also the stocks or the active stocks were not significantly into going into the market. So again, here 74.93 was the lowest support for the week. And again, this is the what we are tracking right now is the 77.90 level to say that the S&P 500 is still healthy despite there are less corporate earnings to track within the week, and at the same time the inflation report, how it would impact the S&P 500, plus at the same time the upcoming Jackson Hole symposium that would be on the last leg of the month. Now we can see here that 77.90 is marked as the major resistance level to break, and 76.15 as well. It was previously served as a test level. Right now, aligned here with the Bollinger Bands as well, it acts as immediate support for the 7600 level. Now, the second support here is 74.93, previously serving as a resistance last week. Now, In technical indicators as well, we can see the moving averages and the Bollinger Band. So it's tracking near the upper boundary level. So this one is a 4-hour chart. Let's take a look on at the same time on the daily chart. So it was really testing the levels of these, or clutching on the upper boundary channel. So I'm using 2 Bollinger Bands just to confirm its volatility because of the inflation report today, plus the EIA crude stocks as well, inventory. At the same time, how this oil report would have impact on the industrial, which is on under the S&P 500 listed companies. Now the RSI as well, we can see it's on a neutral to bullish territory and holding well above that midpoint following during the recent climb toward highs as well. The ATR as well, it reflects current market volatility. It trends underlying the daily price movements. Overall, we can see the bias here because of the key drivers from macro. At the same time, the ongoing news. So again, the S&P, it remains as well resilient with broader bullish structure. You can see as well it's currently consolidating inside the all-time high region. And at the same time, the key pivot as here, we watch this sustained holding above the immediate support of 7,600. So it keeps the path of at least resistance tilted upward toward a retest of this 7790 just to break, or a retest of that as a major resistance barrier. So again, risk management here, a breakdown beneath the immediate moving average and the Bollinger Band here, it would support clusters, would signal there is a deeper correction back toward the secondary supports like the 7493 level. At the same time, the major weekly floor at 7366. So again, the financial and industrial sectors yesterday. So again, we take a look on the factors in terms of the performance for under S&P 500. So here, majority you can see the financial and industrial sectors, they led the top performers with alternative as well. Asset managers like the KKR and Apollo Global Management rising over 6%. Additionally, industrial and electrical infrastructure provides such as the Axon Enterprise, Generac Holdings, and also the Vertiv Holdings, they posted strong gains between 4.3% and 6.7%. So again, with the with having to track this one, earnings doing the heavy lifting during the first and the last leg of July. So let's start with a surprising reality about this market. Even though the S&P 500 has pushed already deep in all-time territory, and at the same time forward to price earnings, the multiples have actually compressed this compared to last year. So here, this bull run is not driven by speculative multiple expansion or hype alone. These rising corporate earnings estimates are doing the heavy lifting. That's why the Q2 is very crucial when it comes to trading. This is the opportunity time for you to take a look at in terms of offsetting your losses. Q2 earnings, again, it's always on the edge wherein have broadly beaten expectations, showing strong underlying resilience across sectors. On the other side of this, institutional and passive equity inflows, they remain at the same time historic. So when we look at the market breadth, over 70% of S&P 500 constituents, they are now trading comfortably above their 200-day moving average, showing healthier and wider rally. Now, however, we are not out of that woods yet, because this week, this critical wall of worry, which is the CPI, and at the same time, retail sales data, these two. So these reports will test whether this resilient economic narrative can weather ongoing interest rate cross currents. So how this trade would be like, how do we trade this setup? So having here on the upside focus, so we are watching closely whether this on the bullish side can clear major overhead resistance at the 77 90, just to cement this clean breakout to new highs. On the downside risk, we are monitoring right now the immediate support, which is around the 7600, at least right along the Bollinger baseline, to see if these deep buyers step up to defend these minor pullbacks. That's why in earnings calendar for the remainder of the week, so the market's really attention is narrowing toward the few high stakes corporate reports that could determine this sustainability of the current AI-driven rally and also the chip sector valuations. Now, we also have this. So as heavyweight provider for this one, we also take a look on the current reports. We have let's take a look first on the earnings calendar. So here, as I mentioned a couple of times, Cisco, these are one of the major catalysts for tech stocks and broader market. And at the same time, it will be reported later. And at the same time, this is a primary player as well in semiconductor. So as a heavyweight provider of enterprise networking hardware and software, the Cisco, the numbers would serve as a vital bellwether for corporate IT spending and enterprise AI infrastructure demand. Wall Street will be listening closely to hear how these enterprise networking upgrades translate right now into top-line growth. And also on Thursday, we have the applied materials, or the AMAT, this one. So we can see as well the forecast would be 8.98 billion with a market cap of 358.5 billion. So here, for the AMAT as well, so this is a primary player again in semiconductor. So their forward outlook is very critical. So investors as well, they will be dissecting their guidance to gauge the ongoing multi-year demand for AI infrastructure, advanced chip packaging, and foundry logic production capacity. So this comes, the S&P has recently pushed its to record territory, but this one backed by one of the strongest earnings growth periods since we've seen since 2021. So again, crucially, markets, or in the analysts, the economists, they point out that the current market gains are being driven more by rising earnings estimates rather than multiple expansion, and also helping to distinguish right now this environment from past speculative cycles. And beyond corporate earnings, investors are also tracking incoming inflation and to gauge the Fed's next move on interest rates. So how are these accounting metrics as well and specific indicators used to evaluate the S&P 500? For this one, we look on the price to earnings ratio. We also look on the aggregate debt to equity or debt to capital, and at the same time, the total free cash flow. So that's how we look on the S&P 500 of how we track its movement. There are three, again, price to earnings ratio and debt to equity or debt to capital. At the same time, the total FCF or the free cash flow. Because cash flow, this is the total cash generated by all 500 firms after capital expenditures. And also growing aggregate FCF, it would also signal underlying corporate balance sheets and capacity for shareholder returns. Now, for the sector by sector accounting breakdown here, we see that they have the segment of the S&P 500. So we have the technology, healthcare, communications. So they are highly evaluated through return or ROIC, return on invested capital. We have the free cash flow margins and cash to debt ratios. And at the same time, for the industrials, we look on the turnover, inventory turnover, days sales in receivables or the DSR, at the same time the current ratios. For the financials, mostly here we look on the capital ratios or the tier 1 capital ratios and loan loss reserves, and also the NIM or the net interest margin. So per sector, that's how we look on the S&P 500 in terms of accounting. just to measure that are those listed companies would provide a surge on the index. Now, evaluating the S&P from accounting standpoint, it involves as well monitoring index level evaluations via the price to earnings ratios and also assessing macroeconomic risk through aggregate debt levels. At the same time, analyzing this corporate health using sector-specific liquidity metrics that is tailored to each industry's business mode. So that's how, when we look not only S&P 500, same thing with how are you going to apply with the Russell Index and NASDAQ. We look on the valuations itself and per industry. Now let's move on the SCPI. So here in inflation, so a high CPI reading, so it would also prompt the central bank right now to raise the real interest rate. So moving the economy upward along the monetary policy curve. At the same time, this contractionary adjustment results in higher interest rate and also a lower level of aggregate output. That is when we apply the economic theory for the inflation rate. When CPI comes high, of course, impact on equities, the stocks, it would generally decline as higher borrowing costs, it would squeeze the profit margins, and rising interest rates, it would reduce as well the appeal of future earnings. For the fixed income, the bond prices will drop, the yields will increase or rise because existing fixed payouts, it would lose its purchasing power and also demand higher returns. For the Forex, the currencies would often strengthen short-term due to expected interest rate hikes. Though there is a chronic inflation weakens that weakens their long-term. For the commodities as well, of course, we expect raw goods generally they rise in value and serving right now as a natural hedge against escalating consumer prices. For the cryptos, so expect risk on digital assets typically suffer short-term sell-offs as there will be tighter monetary policy drains that the market liquidity. And for the real estate, so again, the property values and the market activity, it would slow down. We expect as well on the mortgage because high inflation, it drives up the mortgage rates and construction costs. So at its core, here, CPI is our clearest mirror for consumer purchasing power. So it tracks as the average change in prices over time across a fixed basket of goods and services, everything from housing and also transportation to groceries and at the same time healthcare. So when we talk about inflation, it erodes the household budgets, enforcing the central bank's hands, and CPI is the primary data we are looking at. So again, headline versus the core of dissecting the data. So to read this one, you have to look at it through two lenses, the headline versus the core. Headline CPI gives us the full picture, but it can be noisy. And it includes the food and energy prices. So again, we look on the headlines. How are those retail? How are those food right now? For example, you ordered in Amazon, you ordered from Starbucks. Again, which they are notoriously volatile and susceptible to global supply shocks, weather patterns as well, or geopolitical events. The core CPI, on the other hand, it strips out the food and energy. In short, why do analysts focus heavily on core? Because it exposes the underlying structural inflation trend. And it tells us as well whether these price pressures are deeply embedded in the service sector, shelter, and core goods, or if they are just a temporary spike at the gas pump. So looking at where macro trend stand right now, the global narrative has shifted already from the frantic multi-decade highs of previous years towards a more nuanced normalization phase. So we've seen headline figures moderate as energy price spikes and ease following the past geopolitical disruptions. However, the battle is not completely won. It's not yet. Stickier components like the services, the shelter, and also specific consumer goods, they continue to show resilience. Month-over-month momentum dictates whether inflation is also gliding smoothly back to the central bank's targets or threatening to stall out. So again, the central bank reaction function and the conclusion here is that why this matter for markets. because CPI, it drives the monetary policy. So central banks operate on a dual mandate. Inflation is the primary constraint, and it would keep the interest rates elevated or opening the door for policy easing. You can see the impact of these yields, the gold, and the currencies. So every 0.1% deviation in a monthly core CPI print, it shifts the bond yields, the moves the currency pairs, and at the same time reprices equity risk overnight. So is the S&P 500 about to break higher, or will the inflation data derail the rally? So this week, the absolute main macroeconomic catalyst for the market is the US CPI inflation report. So why is this the main catalyst? Because not just because of the second quarter, but rather, why is this single data point driving all the attention right now? So it comes from three major factors. Again, the monetary policy guidance, and coming off a stretch where the S&P 500 has pushed its already all-time high territory. And also investors are hyper-focused on inflation trends to gauge the Fed's interest rate decisions. Another is data expectations consensus. Of course, the forecast anticipate headline annual inflation taking down to 3.4%, easing from 3.5%, and previously, while core inflation is expected to cool at 2.5%. So market reaction would be a cooler than expected print. It would also validate the broader risk environment and also encourage buyers to challenge overhead resistance. And conversely as well, a hotter print, it would reignite anxiety and also prompting a corrective pullback from record highs. So again, trading implications and what to watch is that with market breadth and strong equities hovering near record levels, how should traders position themselves around this release? So again, that's why we keep our risk tightly managed and watch how price movement respects key technical moving averages, like from the price action that is being done with by Mr. Rafi Capascio, and also prepare for increased volatility as the numbers drop. So that's it for today. I hope I was able to provide you an in-depth of how we look on the S&P 500, not just the corporate earnings, but through accounting terms, economic indicators, at the same time, how it applies with the CPI. It might sound a bit complicated, but that's index. It's totally different from how we track on the Forex as well. And for example, the cryptos and commodities. For S&P, it's not about the trend. This is the economic indicator. We look per industry, how it contributes to the index, and how those figures or valuations or financial sheets providing movement to this S&P 500. Plus, you incorporate as well the economic indicators like the CPI. Now, it's also being powered or fueled by ongoing uncertainty negotiations in the Middle East. So that's it for today. Now, if you want to join, just scan the code here and register for our dashboard and start tracking the markets. And you can also join our Discord. The link is on the description box below. You can also check our copy trading here. So here, you can mirror their strategies, and it's very less complicated as well. So again, you can check this one, and this is very easy to understand. So markets are moving fast, so stick to the plan and make it happen. So thank you for joining today, and I hope today's session provided you with some actionable insights. Thank you for watching, and see you on the next live session.